the first thing that we try to do with these businesses is to tap into the RCF and the line of credit to ensure there is enough liquidity, especially companies that have been impacted by the lockdown or by the COVID-19 because of the shutdown in operations. Clearly, when you look into the US market today, the equity market has almost erased all the losses that they have incurred on the back of COVID-19. Now the question is the real economy. Are we going to see that catch up? If I take an example, the US market, which is a huge market that we invest in, I believe the US market is very resilient. I mean, the US market pre-COVID-19 had a very low unemployment rate. It's the lowest on the last 50 years. We don't see any systemic risk. We have seen a strong capitalization in the banking system in the US. And more importantly, the US government, as well as the monetary policy, has been very supportive of the capital market. I think it would go down to, on the next few weeks, which we have really a limited data, is are we going to see another lockdown? It seems the US President Donald Trump, he is not going to close down the economy because of the next election that is coming in September. So I think our eyes should be on the job creation and the acceleration of job creation in the US, which will actually increase the consumer sentiment and spending, which is 60% of the US GDP.
How important then, Saeed, is the 0% rates? People are saying to me through until 2023. How important is that? But how important is that to Mubadala?
I think, if I look at it from the debt capital market and fundraising, it has been very helpful to us. I mean, if I look historically over the last 10 years, we have done even, a 5-year tenor at more than 6% interest, coupon interest payment. So I think a zero interest environment, it could be very helpful for raising debt. But at the same time, are we going to see an extra fuel in the capital market? Are we going to see an increase in inflation, which will force the Fed to start increasing interest rate? But what's really interesting is this might really help to recover on the M&A activities, because if debt will be available and it's going to be cheap, today we see a dislocation in the market because of the valuation that we have seen over the last few weeks. That might help actually the M&A activities to start picking up over the next few months.
Can we just circle in on that? Do you think megatech is at a 20-year high, Nasdaq's at a 20-year high valuation? Are you worried about valuations, that they're being pumped too high? Does it make it harder for you? So the valuations and the difficulty that challenges.
And that's my personal opinion. I think the easy money have been made on the equity market. And now the question, where are we heading from this point? I think the upside, I won't be able to comment on it, but I always look into the downside on this. I believe we are not going to see actually a real correction the same way that we have seen it post-COVID-19, when the market, S&P have reached 2100. Maybe we're going to see the 2500 to 2700 because actually there's huge liquidity and there is a huge support from the stimulus and the Fed. And the Fed have made it very clear that they're going to do everything possible to stabilize the capital market. I mean, if you would remember 10 years ago, back in 2008, 2009, the Fed was proactive into taking action when the systemic risk was there. I think we live in a different world where valuation highly impacted by liquidity. And as I mentioned earlier, that 6 trillion have played a major role in the equity market and on the debt capital market. I mean, a few weeks after Abu Dhabi government have issued debt, it was just at the beginning of the COVID-19, we were able to raise money very cheap compared to what we have seen previously.